Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, have you been investing in mutual funds through stockbrokers or mutual fund distributors? If yes, there's a possibility that your money was first going into the intermediary's bank account. But SEBI has now banned this practice in investors' interest. The market regulator has also instructed fund houses not to launch a new fund for the next 3 months. To know what has happened, what is the regulation, and how will it impact your investments, watch today's episode.
These regulations are not new. This was announced in October 21, and fund companies were supposed to comply with this by March 31st, and it should have been effective by 1st April. But they are not in readiness. They have not been able to implement it. What is this pooled account? What used to happen typically in the paper times, or when we used to write checks for making our investment, and also when we go to a fund's website and we choose the fund and we decide to make that amount of investment, or give a instruction that okay, I want to invest 10,000 rupees every month, whether it be a investment instruction for a SIP. In these cases, my money used to get debited and the fund company used to get the money credited. We will get it directly. Now, ever since these stockbrokers have started selling mutual fund through their network, there is a new platform at NSE as well as BSE, the BSE Star, which has become a very large platform through which mutual fund investors invest in mutual fund through these stockbrokers. And most of these digital, the fintech companies enabling mutual fund transaction are using it. In this case, what happens is when I give my money, it is not specified that it is going for a specific fund. It is going to the stockbroker, and the stockbroker distributes the money for the instruction that I have given. Assuming that I want to invest 10,000 rupees in 5 funds, goes to the stockbroker. The stockbroker distributes that 10,000 rupees to the five funds. It's not going directly to the fund companies from my account. SEBI doesn't want this. SEBI wants that money should be debited from my account. Mutual funds are more intensely regulated. It'll eliminate the money lying somewhere in between before it gets invested. So this is what SEBI wants to eliminate, the one step in between. It should not get into what is, what in the league, financial jargon is called omnibus, where the money is pooled and then the distributor, they decide. Likewise, the reverse also is true in case of stocks, but that does not happen in case of mutual fund, because SEBI's operating prescription is that whenever you redeem your money, the money gets back into your bank account directly. SEBI is extra careful with mutual fund investors because mutual fund is on a rising tide. There is a lot of tailwind and mutual fund is gaining popularity, and it wants to make sure that mutual fund investors never face a crisis of a kind which can erode their confidence. That is why SEBI wants to be extra careful, and there is a reason why it should be. There have been instances where stockbrokers have defaulted or they have been penalized. Karvi was a big example, because stockbrokers have access to your demat account, and many dormant investors who don't act, they have kept their securities lying in their demat account, and stockbroker has the access to that account. Whenever we open an online broker's account, we give an authorization, we give a power of attorney that the stockbroker can move the securities, and that is needed because whenever we sell, he needs access to those securities. So there has been instances where many of these stockbrokers have defaulted. Many of them have been expelled by the stock exchanges, and 28 of them, they are not small example. Taking a lesson from this example, eliminating the possibility of any such chance, any such risk, this is a straightforward one, and this is something which has happened inadvertently, because the original operating procedure of mutual fund was that we give money and the money gets straight directly to the fund company. In this case, ever since there are multiple things which has enabled this mechanism. There is a national automated clearing house. Whenever you do a SIP through the automated mechanism, you give an authorization to the broker that he can debit 50,000 rupees or 1 lakh rupees a month at the max. And so this is actually a standing instruction that you are authorizing somebody to debit this money from your account. But this will effectively make sure that you will have to clearly specify what this money is. Otherwise, so far it has been a very blanket instruction that okay, you can take 1 lakh rupees whenever you want to, or whatever has been instructed. So there is a trail, but it eliminates the possibility that somebody has access to your bank account. Unless you specify what the purpose is, the money can't move out. It will not change the way investors invest, a little bit, and only when you are investing through a stockbroker, because so far the way the stockbroker used to operationalize your investment in mutual fund was typically get an authorization for the National Automated Clearing House, which is run by National Payment Corporation of India, whereby you give an authorization, a digital authorization, and vet that okay, the bank, the broker can debit 50,000 rupee or 1 lakh rupee at max. You give a ceiling. For investing in mutual fund, they only needed the mandate. They don't need the money, because the money, if they should have access to that money. Unlike stocks where the money should be there with the stockbroker before you buy it. So in this case, one was able to give the money together, and one can give an instruction that okay, buy 3 funds worth this much rupee, or 2 funds or 5 funds or whatever. Now operationally it will change that you will give specific instruction. You want to buy XYZ fund and worth this much rupee and on this date, or SIP. We came to know about this only when one fund company stopped taking money in SIP. The fund company was facing some problem. It was supposed to invest it was investing in foreign securities. Investment in foreign securities was stopped, and that is why the fund company stopped taking money in the mutual fund as well, one-time money. But it continued with the SIPs. The fund said that okay, you can carry on with your SIP, but one-time investment, because we can't absorb all that money, we can't invest that money in the same fashion. So they stopped taking it. That is the time when many investors realized that though they had instructed the broker to do their SIP, but the instructions stored with the stockbroker was not SIP. It was a one-time investment. They took the mandate, and this was done. It was not a forgery. It was not a fraud. It was it was done just for operational convenience. Because many mutual funds have specific rules that one can do the SIP on 7th of every month or 10th of every month. To provide this operational convenience to investors, the fund company said that okay, you choose your date, and the fund company store it, and because they had the access to the investors' money on demand whenever they wanted to, they enabled this facility. And once the fund company stopped taking money, one-time investment, but they continued with their SIP, because these instructions were not SIP in the records of fund companies, these investment could not be made. And that is when investors discovered that though they made SIP, it was actually not SIP. There is one small connection. There isn't a direct connection with NFOs, but there is one small connection, because when we buy mutual fund, when we invest in mutual fund, my money gets debited and I get the allotment of units that very day. In case of NFO, there is a period for which the NFO is open. When the money gets debited from my account, that very day it does not go to the fund. It actually remains with the broker, can remain with the broker, and can be given to the fund only on the last day. Or periodically they might give, but there won't be any problem if they hold back the money. So NFO enables a mechanism whereby the money can lie with the broker for more than overnight, for a longer period, for a couple of days. That makes investors vulnerable, a little riskier, so they want to eliminate. So that could be one connection. The other is incentive as in disincentive. NFO is a very important component of mutual fund business, and if there's a clampdown that you can't launch NFO, mutual fund companies will take this clampdown more seriously, that it is hurting their business. They can get rolling, they can get on with their business more steadily only after implementing this. So this is actually a disincentive, or you can say incentive, for doing it hurriedly or doing it quickly.
Well, with that, it's a wrap. Keep watching this space for more information, and if you like the show, do subscribe to our YouTube channel. Keep watching. Take care. Bye for now.